I don't want to delay in getting started. We do have a lot of information to cover today in what I feel is a fairly short amount of time. And as we begin, hopefully you do have something to take notes with. Let me start out by giving you the phone number here to our webinar department at 1-800-ACCOUNTANT. It is 727-350-9655. Again, that's 727-350-9655. Okay, this would also be a good time to test the audio out on your computer. The sound, of course, is coming through the speakers on your computer or your headphones. If you have any other web pages open that are playing music or have any other audio playing, you may want to turn those off at this time so you can hear the presentation. Okay, a couple important things as we do begin. First off, I do encourage you to lose the distractions. Okay, close the office door, put the cell phone down, turn off the TV, etc. If you're multitasking, you're not going to receive the full benefit of today's webinar, so do get rid of the distractions. Also, to those of you that have not owned a business before, whatever preconceived notion you bring to this call about taxes is probably going to be about personal taxes, and that is not the topic of this webinar today. Everything I discuss will be focused around the business, and business taxes, by and large, are prepared, filed, as well as paid throughout the year. And as a business owner, it is your responsibility to know what your obligations are, who you're to be reporting to, when to file, etc. And failure to file or pay your taxes on time does result in fines, penalties, as well as interest. So when in doubt, don't assume. Always ask your CPA or corporate accountant. And if you don't have someone to turn to, or if you just like a second opinion, of course, that is why you're referred to 1-800-ACCOUNTANT, and we'll be happy to assist. To those of you that have owned a business in the past, I think a lot of the concepts that we go over today should be a little repetitive, as this is just an introduction to business taxes webinar. And if it is just a refresher for you, hopefully you'll still get a couple new points that you were not aware of before. And then on your next appointment, we can just jump right into some more advanced tax planning. And lastly, I'm not giving tax advice today. Now, it may sound like I am, however, I'm not telling you specifically that you should or shouldn't do something. I'm simply bringing up topics and other opportunities that every business owner should be aware of. So there's a lot of good information I'll be going over. I think you'll start to see that I'll begin with some very general concepts, and as we're progressing through the webinar, it'll become a little bit more specific as time moves on. But my goal is to make this dry topic of taxes hopefully interesting for you guys to follow. So a couple of quick tax facts for you. According to the National Taxpayers Union, U.S. taxpayers do spend more than 7.6 billion hours annually complying with tax requirements. That personal tax return that all of us filed, the 1040, the instructions for that 1040, believe it or not, are 189 pages long. The biggest thing I want you to take away from this slide, though, is the last bullet point here. A lot of people don't realize this, but for approximately 9 out of 10 of us in the United States, our taxes are actually our biggest expense every single year. So we pay out more in taxes than we do in, say, mortgage payments or our rent or car payments, insurance, food, etc. So use that as a theme in the back of your mind as we're going through this. How can you use the business as a vehicle to keep more of your hard-earned money? And I'll be showing you a couple ways to do that throughout our webinar. Now, this gentleman here over on the left-hand side is the United States Supreme Court Justice George Sutherland, where in a ruling he said, and I quote, "The legal right of a taxpayer to decrease the amount of what otherwise would be his taxes, or altogether avoid them by means which the law permits, cannot be avoided." Now, tax law, just like regular law, is open to interpretation. I interpret that as it's okay to pay your fair share and not a penny more, as long as you're following the law. So keep that in the back of your mind. It's all about understanding how things work to try to minimize your tax payout. Okay. That being said, our agenda today will be as follows. I'll discuss some new tax law trends, how your business is taxed, what happens when you have a loss or a profit, how to properly pay yourself, commonly missed or red flag deductions. I'll talk about using proper bank accounts, IRS bookkeeper requirements, and then at the end of today's webinar, I will show you how to schedule your one-on-one consultation. So there's two parts. Today is listen-only mode, group setting webinar, and then we'll dive into the specifics of your unique situation on your one-on-one after we've laid this foundation of education for you. So let's talk about some tax trends here first. The IRS did recently request a 5% increase in their audit task force, so a few more of us will get audited. I always welcome an audit. As long as you can back it up and the work done is legal and ethical, you really shouldn't lose too much sleep. The only downside to an audit is the average audit does last approximately 6 months, so it is extremely time-consuming. Okay, second bullet point here, the IRS is cracking down on the tax preparation industry as a whole. Okay, so the tax preparation industry has always been relatively under-regulated, and now they are supposedly going to be regulating it a bit more. I'll give you an example. So let's say you visit a doctor or a dentist for personal use throughout the year. Okay, they're licensed at the state level, so they cannot practice outside of a state that holds their license. And in order to maintain it, their license, they do have to take continuing education hours annually showing they're up to date and changes in medicine. Now, a CPA, Certified Public Accountant, they too are licensed at the state level, so they cannot practice outside of the state that holds their license. And also, in order to maintain it, they do need to take continuing education credits and hours showing they are up to date in changes in tax law, accounting rules, bookkeeping practices, so on and so forth. Now, you don't have to be a CPA to prepare a tax return. However, there are new laws that are going back and forth, saying yes, saying no, about having to continue to maintain continuing education requirements. We'll see how this pans out. It tends to flip-flop back and forth every few months right now. And then the last bullet point on the slide, recently banks and other financial institutions are reporting your merchant transactions to the IRS on a new tax form, the 1099-K. And a lot of businesses, and I understand this, have been screaming privacy behind it. If you're not a publicly traded company, why are your numbers being revealed in this great of detail? Well, it's already happening. The IRS just wants to be sure what you're claiming is actually happening. Okay? So this next slide here has a lot of opportunities on it, different tax law changes for small business. And I'm not going to go through these, let alone one of them. We meet here the rest of the week. I'll point out one thing. If you move your eyes down this slide, you'll notice the word credit appears numerous times. Now, a tax credit, if you don't know, that is dollar for dollar, so it really doesn't get much better than that. If there's, let's say, a $1,000 credit that you're eligible for and we successfully claim, that's $1,000 back into your pocket. Okay? Or maybe $1,000 less that you owe, or perhaps an extra $1,000 on top of the refund that you're already receiving. But if you don't claim it, you do lose it. Okay, there was a really good article in the media not too long ago. It was referencing a tax credit from the previous year. And this one in particular was a $2,500 education credit. You didn't have to be a business owner to do this. It was for individuals. But the interesting part about the article was that only 63% of eligible Americans claimed the credit. So why in the world were only 63% of those eligible claim it? What happened to the rest of the people? Lack of knowledge, I assume. I'm not sure. But perhaps they didn't know that it was offered. You see, a tax credit is not just on your personal return. You absolutely must know that the credit exists. Make sure all the paperwork is filled out appropriately, and then reflect that credit onto your personal or business return and submit it when it's due. But again, if you don't claim it, you do lose it. The only way you can go back and reclaim a credit or a deduction for that matter would be to amend a return. An amendment is a refiling. And when you amend a return for anything that's going to benefit you financially, you really are opening a can of worms for an audit. So it is imperative that you do get it right the first time. So lots of great tax credits and deductions for both individuals as well as This is a couple very, very important slides we'll be going through right now. So I've gone over some very general stuff. Now we're going to start to get into the specific. So how is your business taxed? I'm going to go through each of these briefly. As I do, if you think it does not apply to you, I still encourage you to pay attention for a moment. There's actually a chance it may apply to you and you not realize it, but it could apply to you now. It could apply to you at some point down the road. And we'll start at the top, sole prop or a DBA under your personal name. Okay, you're probably going to be taxed the highest. And the reason I say that is because you're subject to not only your regular federal or state income tax, national average is around 25-28%, but on top of that, you also have to add on an extra 15.3% in self-employment taxes. Okay, so if you add that 15.3% to the existing, call it 25 or 28, of course that's going to vary based on how much money you make, it could leave you paying 40% or maybe even higher as an overall marginal tax rate. Definitely leave you scratching your head wondering what happened. So the challenge really with a sole prop is to reduce the profit. Okay, and as counterintuitive as that sounds, you are taxed on the profit of your business, not the income. So we do want to take advantage of the handful of deductions that are offered through a sole proprietorship to reduce your overall tax bill, or when you receive a certain threshold of profitability, you may want to consider a more formal structure as well, simply to keep more of your money. And sole props also, by the way, do have the highest audit rate as well. Okay, the LLC, this is a hybrid entity. It's sort of like a cross between a sole prop and a corporation. And the interesting part about the LLC is that it does not come with an inherent tax structure. You actually do need to set it up or build it. Okay, and what I mean by that is the LLC's annual return, I'm not referring to its quarterly or monthly filings that may be due, but the LLC's annual return can be prepared on 4 different sets of paperwork. Okay, a couple of very important things to take note on here. Number 1, you do not choose your LLC's annual paperwork at the end of the year when it's time to file that return. Okay, rather we choose in the beginning of the year, or if you've just recently set up your LLC, you do it immediately upon forming the entity, and it is time sensitive. And if you think about it, it actually makes perfect sense. Why would you choose your tax structure in the beginning and not the end of the year? Well, it's because business taxes are done throughout the year. So we don't know how to take money out of the LLC to pay ourselves unless we know our tax structure. We don't know what deductions we would claim unless we knew what forms we'd be putting them on. And in some cases, we don't even know filing dates. Okay, so that's why we choose in the beginning. Now, the second important thing to take note on is that if you do not choose which tax structure you would like, the IRS is going to choose for you and tell you which tax structure you're going to have. Okay, and when they choose for you, will they choose what benefits them or benefits you? Well, their job is to collect revenue, so they're going to do what's best for them and take away as much of your money as the law will allow. In fact, if you look back up at the top, if you don't choose, they're going to default you to a sole proprietorship. So the LLC does not come with a tax benefit. It's all about liability protection, hence the name. Okay, now if we would like to receive a tax benefit out of the LLC, we have to apply for it using a special set of tax forms. And we do this by making what's called an entity classification election immediately upon forming the LLC. Again, it is time sensitive. And when we do this, if approved, it could actually reduce your self-employment taxes on average by about 50%. So it is fairly significant. You know, if I told you you'd be able to reduce the tax by 1 or 2%, I don't think anybody would be opposed to that. But again, a 50% savings, I'll take that every day. Okay, let's continue to go through the different structures. The S corporation, this is a pass-through structure. The profit or loss is going to pass on over to your personal tax return. Okay, you will need payroll to pay yourself throughout the year. I'll talk a little bit more about paying yourself on the next slide. To the C corporation, you always hear about double taxation, and I know from experience a lot of newer entrepreneurs sometimes are intimidated by that term. And what double taxation refers to is being taxed on the corporation's profits at corporate tax rates, which are different than personal income tax rates. And you're also taxed on the money that the corporation pays you as an individual. So that's all that means. Okay, and some people ask, should I be an S Corp? Should I be a C Corp? Or how should I tax my LLC? Or maybe when is the best time to transition from a sole prop to a more formal structure? And our response will be the same every time, and that is it depends. Okay? What are the corporate tax rates for the year? What are the personal tax rates for the year? How much profit are we expecting? What types of deductions may we claim? What types of benefits would we want our company to provide us with, etc. Okay, and then nonprofits, very easy to explain from a tax perspective. The nonprofit does not pay taxes on the profit. Okay, nonprofits' profits are not taxed. Okay, they're simply reinvested back into the cause. However, if you are the person that's doing the work for the nonprofit and you would like to get compensated for that time or effort that you're putting in, then you, of course, will be taxed on the money the nonprofit pays you. But again, the nonprofit's profits are not taxed. They're just reinvested back into the cause. And there absolutely are nonprofit tax filings, but again, there's no taxes are paid on the profit. But it's still a business. It's a corporation. We treat it like a business. But that's the very basics on how the different structures work. And I assume that for many of you, this probably poses some additional questions. Just jot those down for me. Again, we're not training you to be a CPA here during the webinar. We're going over a wide variety of topics here and just trying to give you an overview today. And we'll talk more specifics on your next appointment, on your one-on-one consultation. Okay, let's talk about paying yourself for a moment. This, of course, is why we start a business, to make money. But we also have to be aware that the money that our business makes is not our money, it's the business's money. So if you'd like to see any of that money that your business makes to get your personal bills paid, etc., we would have to figure out how to get the money from our business to ourselves. So the diagram to the top right sort of illustrates that. First, we see the flow of money into the business. Okay, this is income, and you're not taxed on income. Okay, you're taxed on that second arrow when the business gets you the money. Now, how the business gets you the money will be one of the determining factors of at what rate that money is taxed. So whether that money is paid to you in bonuses or distributions or dividends, draws, salaries, there are many different ways to take money out of the business. Of course, we want to do it in the way that's legal, but also the way that's going to incur the least amount of tax. Okay? And to the sole props or the DBAs under your personal name, again, that money just passes through to you. You're taxed at that slightly higher rate I had mentioned a couple slides ago. And if you're an LLC, you're actually the only one we cannot answer this question for today because we don't know how you're electing to tax the LLC. But do know that if we apply and get approved for that preferential tax treatment that I referred to, it does allow us to get the money out of the business a little differently. It allows us to pay ourselves in what's known as distributions. Okay, it's sort of like receiving bonuses from your company throughout the year. Beautiful thing is these distributions are not subject to any of that 15.3% self-employment tax whatsoever. Again, very, very significant. Self-employment tax, by the way, that includes Social Security, federal unemployment, Medicare tax. If we do decide to go down this route and apply and you get approved, the tax savings can be fairly substantial. It can be, in many cases, worth thousands of dollars each and every year. To do this, there is an extra step. We have to pay ourselves a, quote, fair and reasonable salary. It's actually a good thing because the salary that the LLC pays you is then a deductible business expense for the LLC. Okay, and to the S Corps, there are two forms of compensation. You do receive distribution as well as salaries. Okay, the distributions, the bonuses that I just referred to are identical for the S corporations as they are as an LLC that's been approved for an election. Okay, to the C Corps, again, very similar to that of the S Corp, except the distributions are now called dividends, and you too pay yourself a fair and reasonable salary. Now, S Corps and C Corps do have quarterly payroll tax filings that need to be addressed, and I'd say about 75% of our LLCs that we see here are also required to file taxes on a quarterly basis. And I'm just referring to payroll filings on a quarterly basis right now. There could be other federal income tax or state income tax filings or sales and use tax due every month. But again, we're just talking about paying yourself, hence payroll taxes on a quarterly basis. Actually, let me do this. I'm going to take the topic of pay just one step farther real quick. Everyone just move your business to the side for a moment. Pretend you didn't own a business. Pretend you work for somebody else's business, or maybe you still do as an employee. Let's talk about how you get paid there. So let's say every other Friday you get your paycheck or your direct deposit, and then on that pay stub it shows your gross pay before taxes. It shows where the taxes are withheld in the middle, and then it shows your net pay, the amount of the check or the direct deposit. Okay, now where those taxes are withheld in the middle, we see it itemized. Social Security tax, federal unemployment tax, Medicare tax, state income tax that applies, federal income tax, any city tax, etc. So where those taxes are withheld in the middle, that's where that national average of 25, maybe 28% is withheld. So a quarter upwards of possibly even a third of your money, if you're making into the six figures, you actually never touch. Okay, your employer is withholding the tax dollars from your paycheck, and then they are paying the appropriate government agencies throughout the year. And for each one of those taxes I just itemized, that's actually a separate government program. So they're sending Social Security tax, the money, as well as the tax forms, to one processing center in one state. They're sending federal income tax, the money, as well as the tax forms, to another processing center in another state. So they do that for all the different types of taxes. Okay, now the IRS, that's the governing body over all of these different tax initiatives. Okay, but the money as well as the tax forms go to the different locations throughout the year. And then what happens is at the end of the year, call it towards the end of January, you get your W-2 that shows how much you made throughout the year. It shows the amount of taxes that were withheld by your employer and paid for each one of those different tax initiatives. Okay, and then you take those numbers from your W-2, you plug it into however you do your taxes, and poof, 30 minutes, an hour later, you're done. I think most people have that mentality of hoping for a high refund, which I'm sure for some of you probably heard of that called as an interest-free loan you're giving the government. But that's just an example of how your taxes are actually not paid once a year. Your employer was actually doing a lot of that work for you. So if you work for someone else's company, you may file your personal tax return once a year. Adjustments are made. Maybe you get some money back. Maybe you owe a little bit, whatever the case may be. But it's the same thing when you're running your own business. Okay, taxes are paid throughout the year. Adjustments are made at the end of the year. Okay, you don't have to have employees to be required to go through the process of filing throughout the year. You can be a single member LLC, the person who owns the company that's also doing the work, and be required to pay and report throughout the year. So I think that clarifies just a little bit more on the topic of paying yourself. Okay, let's talk about the opposite for a moment. What happens when we have a loss? Of course, we're in business to make money, not lose money. And it really doesn't matter what type of business you have. It generally costs thousands of dollars to start any company. So a loss is referenced here on the diagram over on the right-hand side. In this example, we have a $10,000 loss. Okay, so let's say these are your numbers for the year. Let's say that you've got an LLC or an S-Corp or a sole prop, something that passes through to your personal return. So you have this $10,000 loss with your pass-through business. And let's also say this year you have $50,000 worth of W-2 income working for somebody else's business. So call that your day job. So that negative 10 is going to pass through to your personal return where that 50 is. So 50,000 minus 10,000, now you're only taxed on 40. Okay, but do you see the discrepancy here? Okay, your employer was withholding taxes as if you should be taxed on 50. And when we connect the two returns together, now you're only taxed on 40, so you get a much larger refund back. Make sense? Okay, it's called a paper loss. It doesn't mean that you're not successful or you're not making money. Keep in mind that the compensation your business pays you is also a deductible business expense. So you can still be very successful, make money, live a great life, and show a loss on paper for your business. Okay, now C-Corp losses do not pass through to a personal return. They actually carry forward to the next year's corporate filing. Some of the expenses are obvious. You know, if you set up a new entity, I think that's a fairly obvious business expense. Maybe a $12 business lunch may not be so obvious where you're discussing business over a meal. But it's also those small regular transactions that generally do add up to thousands of dollars over the course of the year. So the goal is to deduct as much as possible to try to offset your regular tax bill. Okay, now, in order to do this, you do need to look like a real business. This is extremely important. You need to look like a real business. You see, there's actually a business versus hobby argument that's been around for decades, which says businesses make money. You have the ability to spend the money, okay, on hundreds of possible legal business deductions, and whatever you don't spend is your profit, and then you're taxed on your profit. So again, you want to spend the money that you make on legal business expenses to reduce your profit. A hobby, on the other hand, hobbies just spend money. Hobbies don't make money. Okay, if you don't make any money, you can't be profitable, and the government cannot tax you unless you are profitable. So believe it or not, the government does want you to succeed, so they can take a portion of your money away by taxing you. So if you show a loss, you're actually receiving tax benefits, meaning you're either getting money back from the government or you're able to utilize those expenses in the following year. And when you have a profit, you have tax liability, meaning you owe. Okay, so I tell you the business versus hobby argument so you know to look like a real business. Okay, if you haven't done it yet, get a business phone number. Why would you want to get a business phone number? Well, do you really want to put your personal phone number that's on your personal tax return on all of your business tax forms throughout the year? Absolutely not. You're blending the two activities together. There's actually a free service, by the way, called Google Voice. Doesn't cost you anything. Check it out. You can get a business phone number, have it forwarded to your cell phone. You can even have a separate answering machine, and you can put that phone number on all your business tax forms. Okay, get a business website, register yourself in directories. Just try to have that professional appearance, because when you're first starting up, you're generally paying thousands and thousands of dollars worth of legal business expenses. And what we want to do is make sure that we're viewed as a real business and a hobby. Okay, some other considerations, just ask yourself if any of these apply to you. Maybe you've received some unemployment income recently, a severance package, perhaps if your income's a little bit higher than normal. Did you take money out of a retirement plan?